Welcome everyone. What if I tell you that a company can double its profits without selling a single extra product? Will you believe me? What if I tell you that taking loan is not a bad thing for a company, but borrowings can actually make your company richer than your competitors? You might wonder that some companies collapse after taking the loan, while others use the same loan to make their company a global giant. Well, the answer lies in one of the most powerful concepts of finance, that is leverage. Today, I will show you how leverage can multiply your wealth or destroy your company depending upon how you are using it. Now, let us first look at the definition of leverage. So, in finance, leverage means using borrowed funds or fixed cost to magnify the potential return on the investment. So, leverage simply means that you are using loan, you are using someone else's money to increase your profit, to increase your gains. So it's like using a small effort to lift a big weight with the help of a lever. So you can see in the diagram here they are lifting a big weight with the help of a lever. This small triangle is a lever. So lifting up such a big weight is a quite difficult task, but since lever was present here, it becomes an easy task. So leverage is basically that you are using someone else's help, some outsider help, to lift your company at a larger scale, to build your company with a higher profits. So if we look at the technical understanding of leverage, if leverage is zero, no leverage, you can only use your own money. So if leverage is zero, it means debt is zero. Your entire financing of the company is depending upon equity share or preference share. And if there is leverage into the company, it means you have taken the loan from the outside party. So leverage is basically the loan that you take from the outside party in order to build up your business exponentially. Moving ahead, there are three types of leverages. One is operating leverage, another is financial leverage, and third one is combined leverage. So operating leverage, what is operating leverage? It deals with operating profit. It tells us how much my operating profit will change because of change in sales. My profit is dependent upon sales, right? So operating profit is nothing but earnings before interest and tax. So because of change in sales, if there is high impact on operating profit, if there is high impact on earnings before interest and tax, it means my operating leverage is high. But because of change in sales, if there is negligible impact on operating profit, it means my operating leverage is low. So this is how operating leverage is defined. Now understand, because of change in sales, my EBIT is changing. That is how we are explaining what is operating leverage. Because of change in EBIT, my earning per share will also change. Earning per share is how much shareholders are earning, how much one share is earning. So because of change in EBIT, when I measure its impact on change in earning per share, that is what we call financial leverage. And if we look at the overall impact, that if because of change in sales, that is in operating leverage, how much my earning per share is changing, that is what we call combined leverage. So combined leverage is nothing but multiplication of operating leverage and financial leverage. We have already discussed the practical sums related to it, but you must understand that what every leverage tells us. So operating leverage is, it will tell us about the operating profit, that how much change is coming into operating profit because of change in sales. Now if operating profit is changing, the earnings of shareholder will also change. So if we measure that how much the EPS is changing, how much earning per share is changing because of change in EBIT, that is measured by financial leverage. And if we measure the overall impact, that is how much my earning per share is changing because of change in sales, that is what we call combined leverage. Yes, now let us discuss that financial leverage is nothing but trading on equity. These are two different terms having the same meaning, having the same objective. Trading on equity will tell us how much equity share need to be used. Financial leverage or leverage tells us how much debt is need to be used. So when I am asking how much equity need to be used, it means I am asking that how much money need to be arranged from equity shares and how much money need to be arranged from debt. When I am telling you leverage, it means I am asking how much money need to be arranged from debt and how much money needs to be arranged from equity shares. So leverage and trading on equity is one and the same thing. Now since you understand that what leverage is, let me ask you a simple but powerful question. Tell me that can borrowing money actually make shareholder richer? Most people think that debt is risky, but the answer might surprise you, because you must understand that leverage and trading on equity is a concept that will tell us how much money needs to be arranged from debt and how much money need to be arranged from equity share in order to generate extra profits for our business. But you must understand that there is a twist in it. We need to use this debt very wisely. If we are not using it wisely, then definitely our company can enter into losses. Now what is the twist? The twist is that when you take the debt, you pay the interest. Yes or no? When you take the debt, what you pay? You pay the interest. Now, if your earnings are more than this interest that you are supposed to pay, shareholders actually gain. And this situation is called positive leverage. I'm repeating, listen to me. Whenever you take the debt, you need to pay the interest. And whenever you arrange money through debt, you do business out of it, you earn profit. Whatever profit you are earning, if it is more than debt, if it is more than not debt, if it is more than interest, it means your shareholder will earn money, and this situation is called positive leverage. But if company's earnings are equal to or less than the cost of debt, if your profit is less than the interest that you are paying, then shareholder also lose in that particular case. So this is what we call negative leverage. So let me put it very simplistically. Debt is like a booster. Loan is like a booster. It can push shareholders' return upwards if it is used wisely. But it can also drag them down if earnings aren't enough, if profit isn't enough to cover up the cost of debt, to pay the interest. And this is why financial leverage is often called as double-edged sword, because it can work in favor of you as well, and it can work against you as well. When it will work in favor of you, the answer is simple. Everyone knows that if my company earns profit, it works in my favor. If my company earns losses, it works against me. Understand why it is happening. See, if I'm using debt, if I'm using loan for the purpose of doing business, it means that my number of equity shares are less. The money which is required to run my business, if the entire money is arranged through equity share, it means more equity shares need to be issued. Yes or no? More number of equity share means earning per share less. What is earning per share? For example, there are 10 equity shareholder and my earnings are 100. In that particular case, earning per share will be 10. 100 divided by 10. What if my number of shareholders are 20? Then 100 divided by 20, my earning per share will be 5. It means if more number of shares are issued, earning per share decreases. So instead of issuing more shares for arranging money, I can use debt in that particular case, so that number of shareholders remains less and earning per share can be increased. But this situation will work in favor of me only when if my company is earning profit. Because if my company is earning loss, understand, for loan interest is need to be paid irrespective of the fact whether your company is in profit or your company is in loss. If your company is in profit, you can distribute that money to shareholder. Shareholder will earn on the shares that they are holding. Fine. But if your company is in losses, no need to give anything to the shareholder. No need to pay dividends to the shareholder. No need to provide earnings to the shareholder. So if your company earns into profit, shareholder can gain. If company earns into losses, it is the choice of the company that they are not paying anything to the shareholder because they have not earned anything. But this choice, remember, does not exist when you take the loan. Whether your company is in profit or your company is in loss, interest is need to be paid. So if your company is in loss and you pay the interest, loss increases. Yes or no? Your company is in loss. Let us say the loss is of 50 rupees and interest on loan is 20 rupees. So 50 rupees is your loss, 20 rupees more you are paying. So the value of total loss becomes 70. In that case, shareholder will suffer losses. Whereas if you're earning profits, definitely since number of shareholders are less, you have not raised money by issuance of equity share. In that particular case, shareholder will earn profit. So that's the entire case. That's why it is called double-edged sword, because it can work for you as well and it can work against you as well if your company is earning losses. Moving ahead, let us discuss the last theoretical topic of leverage, that is financial break-even point. So what is financial break-even point? I have told you that a blend, a mix of debt and equity need to be used. Fine. But there is a point where it does not matter how much debt you are using, how much equity you are using. It means whether you use the debt or not, there is no impact on earning per share. So if you are using equity as an entire medium of funds, earning per share will be same. If you are using debt, then also earning per share will be same. So this particular point of operating profit, where EPS remains same irrespective of the fact that whether debt has been used or not, this point is called financial break-even point. Fine. So let us understand this. You will develop understanding into it. Let us take an example that your earnings before interest and tax is 80,000 and you have issued 1 lakh equity share and every share is worth rupees 10. Fine. In case number 1, we will assume debt is 0. In case number 2, we will assume that 50% of money is arranged through debt, 50% of money is arranged through issuance of equity share. So if my EBIT is 80,000 and debt is 0, what will be the earning per share? 80,000 divided by 1 lakh, that is the number of equity share. Yes or no? If total profit is 80, how much one equity share is earning? Simple. 80,000, that is our total profit, divided by number of equity share, that is 1 lakh. So every equity share is earning 0.8 rupees. Case number 2, what if 50% of money is arranged through debt, 50% of money is arranged through equity? So it means 50,000 debentures will be issued, 50,000 equity share will be issued. Now if 50,000 debentures are issued or 50,000 instruments are issued, what is the cost of one instrument? What is the cost of one debenture? 10 rupees. So 50,000 into 10, it will give us 5 lakh rupees. And let us assume that rate of interest is 10%. Let me write it here. That rate of interest is 10%. Tell me how much debentures are issued? 50,000. 50,000 debentures are issued. Price of one debenture is 10, so total 5 lakh rupees is coming inside our pocket. And what is the interest? 10%. So how much interest we are supposed to pay? 50,000. Yes or no? 50,000 interest we will pay. In case number 2, how much is my profit? 80,000. How much interest I paid? 30,000. How much is left? Yes, so 80,000 is the profit, 50,000 is the interest paid, left is 30,000. So 30,000 divided by number of equity share. Now number of equity share is 50,000 in this case, because half we have arranged through debenture, that is debt, half we have arranged through equity. So 30,000 divided by 50,000 will give us 0.6. Yes, is it clear? 30,000 divided by 50,000 will give us 0.6. So can I say that because of issuance of debt, my earning per share has reduced? Yes or no? Because of issuance of debt, my earning per share has reduced. It means debt worsened the situation for us. Debt has worsened our situation. Any doubt in this? That's why leverage is called a double S sword. But if my earning per share will be more, I will discuss. Let us say that this time instead of earning 80,000, we earned 1 lakh rupees. We earned 1 lakh rupees. Okay, this is a situation of negative leverage. Any doubt in this? Because of taking loan, my earning per share is decreasing. So this is a situation of negative leverage. Now let us discuss, if my profit is 1 lakh, what will happen? Entire money is generated from equity. 1 lakh share we are having. So 1 lakh divided by 1 lakh, my earning per share is rupee 1. Every share is earning rupee 1. Another example, what if 50% is arranged through equity, 50% is arranged through debt? Let us say that if how much interest I am paying in case number 2? 50,000 of the interest I am paying in case number 2. Yes or no? So 1 lakh is my profit, 50,000 I have paid. How much is left with me? 50,000. How much are the number of shares in case number 2? 50,000. So 50,000 is left. 50,000 divided by 50,000. Again, my earning per share is rupee 1. So can you see that it is not the matter of fact that whether entire money is arranged through equity or a blend of equity and debt is used? My earning per share is same. So when my earning per share is same, that situation is called break-even point, because my earning per share is same whether I am using the debt or whether I am not using the debt. Now here is the learning, that if I earn even a single rupee more than 1 lakh, because 1 lakh is the break-even point, if I earn even a single rupee more than 1 lakh, I will be having a positive leverage. It means the impact of taking debt, it will have a positive influence on me. Let us see. Let us say this time your earnings is 1,20,000. Case number 1, entire money is arranged through equity. So 1,20,000 divided by 1 lakh, that are the number of share. Every share is earning 1.2 rupees. Earning per share is 1.2. Now what if 50% of money is arranged through debt? Tell me, what is the interest? 50,000 again. So out of 1,20,000, 50,000 has gone. How much is left? 70,000. How much is left? 70,000. And what are the number of equity share in case number 2? 50,000 are the number of equity share. So I will divide 70,000 divided by number of equity share 50,000. The answer is 1.4. The answer is 1.4. It means every shareholder is earning 1.4 rupees. So can I say because of using the debt, my earning per share has increased? This is what we call positive leverage. Now I think the entire concept is clear, that how I can use my debt. So if I am interested in using the debt, I should earn more than 1 lakh rupees. If my profit is 1 lakh or less than 1 lakh, then debt definitely is not an option for me. I should refrain myself for using the debt. So if I expect that more than 1 lakh rupees will be earned as a profit by me, in that particular case, using debt is suggested. And this is what you will suggest to your clients. When you will get the degree of BCom, when you will get the degree of CA, when you get the degree of CPA, when you get the degree of ACCA, then you will tell to your client, see, this much profit you are supposed to earn. If you will earn profit less than this, then taking debt is not suggestible. Whatever business you are doing, if you are expecting there are profits will be less than 1 lakh, do not take loan. But yes, if you expect that you can earn profits more than 1 lakh, then definitely you can go and take the loan. That will increase your earning per share, because it will have a positive leverage, it will have a positive impact on your business. So that's all for the theoretical understanding of concept of leverage. See you in the next lecture. And remember what we learned today? Today we saw how leverage works like a double-edged sword. What is the meaning of operating leverage? What is the meaning of financial leverage? What is the meaning of combined leverage? And remember, debt is not always bad for a company. It is a powerful tool, but it is like fire. In right hands, it can cook your food. In the wrong hands, it can burn your house as well. So the real question is, it should not be that should company use leverage or not, but rather how wisely it can be used to maximize your return without increasing the risk beyond your control. Think about it. If you are the CEO of the company, how much debt would you take and why? Take care. Have a nice day.